next stock is actually one that for not the Intel community, but the YouTube community has some interest in, and that is a brands company that's up and coming. Do you want to guess which one it is, Austin? I'll give you some more hints if you're not sure, and you can ask for a hint.
I have 2 guesses.
Okay.
All right. I'm going to go with my first guess. It's The Honest Company.
That is the one. So
Nice.
The Honest Company. So again, before anyone cringes at this, this is not saying, we're not saying that this is a buy. We're just added stuff to the list that either we think is interesting or we know that the YouTube community thinks is interesting at the moment.
And that we're going to do further due diligence into itself.
Yes. So this is just preliminary analysis. So let's again apply the 15 standard. I am not familiar personally with the growth rates of Honest, but I assume actually, let me actually put in their ticker, HNST. Yeah. Oh, didn't mean to do that. So that's still a no. Okay, so I'm getting terrible buy prices already, but let me see if that changes. So I think they are profitable on a cash flow basis. No, they are not. Wait, no, got to make sure.
Yes.
Yeah, I don't think they are. So then what we have to do is, if not profitable, we assume a profitability metric. So what I would do is, how aggressive do you want to be, Austin? There's no wrong answer. just know that you're being aggressive if you are. Okay. And same with everyone out there. Just know Austin is being aggressive if he chooses to be.
Let's say in 5 years, they become profitable, Fabio.
No, but what percentage? How profitable are they going to be? I have it right now at 7 because that's like the standard that's on the model.
Let's just throw on 15%, Fabio.
Okay, so they're making 15% cash. So you see it as the model changed. So 15% growth rate. Actually, let me quickly see. Okay, so HNST. Let's just get a quick, prediction of the analyst. Okay, so well, actually not the analyst, but let's see what they did. So 27. Let's be aggressive on this end. Let's say to do, I don't know,
30,
like 35. Yeah, 35. Yeah. All right, so there we go. 35% growth. Again, 30% watch growth. This, if I take this out and they go to a bad number, that means they're not profitable. All right. So just so everyone knows. So we're assuming profitability, long-term profitability. And then we're applying that to the model. And then this is a 10-year model. So 35%, 30%, 27, they continue to grow at this rate. And let's actually let's move this guy over here, and let's do actually back. Yep. Let's do it that way. And then
10.
Pessimism.
5%.
Yeah, just like out there, because I went out there with the 35. I'll go out there with the growth rate on the downside. So Austin, was this a 15% an aggressive one for you? I forgot if you said that.
Honestly, Fabio, just because I have no idea really what the story behind this company is, I can't really price in a aggressive or non-aggressive amount within like what I think it could do, if that makes sense. So in essence, what I'm basically trying to say is that 15%, I literally just kind of threw in there, which is kind of, I guess, the point that we really want to illustrate with unprofitable stocks. Like, you have to legitimately estimate when it could be profitable and how much it could be profitable by at a certain period of time. Would that be correct, Fabio? Yeah.
And by the way, I think 15% is pretty aggressive. Because I'm looking at, well, I don't know if ELF is a proper example, but if we look at like ELF Beauty, they sell makeup, Honest sells makeup. That's why Seeking Alpha is like shoving them in here, and also their market cap sizes. But I think 15% might be on the higher end side. But let's
7%. You want to just throw in a 7 there?
I think 7's on the lower. I think ELF has around close to a 10%. But
10% then, yeah.
But we just have to acknowledge it's aggressive. That's it. We just acknowledge it's aggressive. So even if we put in a 10%, yeah, it's still there. It actually didn't change any of the outcomes. So those are the buy prices. If we assume a 15% discount rate of return, required rate of return, we assume no dilution. That's probably not ignore that -7 by -6%. We're assuming no buybacks or dilution. So let's look at some key ratios. Let's ignore these for now. This one's going to be important, but because it's an inventory heavy company. Anything good here? I say yes. Yes, it makes sense. They just IPO'd. Total debt ratio. Yeah, it's getting lower. Pretty good, I guess, for what they are for this industry. I'd like to see higher. Some companies in their industry have 40%, but you know, they're just getting started. We're not. It might be a good company one day. While I'm looking through this, Austin, what are your thoughts on their brands? What are your thoughts?
Other than like what you've told me about how your wife has recommended the company before, this is kind of outside of my scope.
Recommended the company?
No, or like recommended their brands before. I mean,
brands, yeah.
Yeah, and sorry, there's a bug around here, but honestly, this company itself is kind of outside of the scope of an investment that I would usually look at. So I'm going to completely keep it transparent for the audience. I'm coming into this blind. This due diligence is going to be completely blind. I really have no background knowledge I can draw from regarding this particular industry itself. So this is going to be a really interesting, almost challenge for me, Fabio, because especially with the way that my mind works, I'm going to see numbers and I'm going to be like, okay, this isn't lining up. This isn't lining up. But it's also going to be interesting too, because I'm going to learn a lot. And I kind of hope too that the audience like learns from what I'm learning from when we do the honest company, when we do the due diligence of the honest company. So
while you were saying that, I was noticing these inventory numbers are actually pretty terrible. They're getting worse on a lot of metrics. Again, new company, they could be improving in the future. That's an assumption. But yeah, doesn't look too good on the inventory front. But new company, just right now, they don't look too good. All right. So that was the quick look at that. Back to the summary report. Quick and brief conclusion, Austin. Interested in looking deeper? Or you're kind of
I would be very interested in looking deeper into this company just so I could learn a lot about this particular industry it's in, and especially dealing with a company that just recently IPO'd in essence. And then also too, kind of learning more about how we can make these assumptions of where the company could go into the future. So yes, Fabio, I would be probably interested in doing more due diligence. As of right now, though, if I have a personal interest in the company myself, being honest with you, no, I do not. Yeah. But that doesn't mean that I don't want to do my due diligence. It doesn't mean that I don't want to look into this company with you, Fabio. Yeah. How about yourself? Would you agree with that or disagree?
What I've been getting the feel from is like my wife saying, you know, if we have a kid soon, then she's willing to pay up for more expensive things for the kid. So would I be? And I think a lot of parents out there too, and I know the honest brands are a little more expensive, but when it comes to children, parents sometimes, you know, for obvious reasons, have greater sentimental attachment to their children and are often willing to spend more. I mean, do you want to talk about Disney? Yeah, and how much a vacation there can cost? And parents are perfectly willing to spend that money in order to make that child smile. So can you imagine when it comes to, you know, comfort, health, stuff like that? So something to think about. They also have a cosmetic division, but you know, I don't really use their products, so I wouldn't know.
We hope that you've enjoyed what you've seen here today. If you have, please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. And we look forward to seeing you guys later.